Now we'll take a look at how to project future income statements in the FAT. There is no need to project future balance sheets, as they will automatically be generated for the next 5 years. There are 7 ways to project each expense line item in the FAT, each of which I'll go over here. The first is no growth, which implies no increase in the expense account. Next, we have regressions by year and by sales, which attempt to find a linear relationship between the expense line of interest and either of the two variables. Steady growth is just percentage growth each year, and manual growth shows each year's growth in the expense account. Percentage of revenue is as the name implies. Finally, we have manual, which allows you to manually input the values and supports Excel functions. Now we need to decide which projection methodology to use for each expense account. In making this decision, you should use a combination of historical data, industry data, and your own professional judgment. When looking at the historical data, you should try to figure out the relationships between expense items, revenues, cost of goods sold, and time. If the expense line item seems to be increasing with revenues, use percentage of revenue; with time, use steady growth, etc. Always be sure that your rationale for an expense increase is grounded in solid economic theory. Note that if you have an interim income statement, it will show up over here. By toggling the button at the top, the statements can be annualized. If you choose to use the interim financials to project the current year, make sure that you pay attention to costs that may not have been recognized yet, such as year-end accounting, and include them in your projections. In addition, if there is any seasonality to the business, make sure that you take this into account before annualizing revenues.